Look, I'm going to be straight with you. While most people spent the New Year weekend nursing hangovers and watching bowl games, I was staring at my terminal watching something remarkable unfold in the silver market. And the eerie part? The financial media is completely silent about it. They're already writing the obituary for this silver rally. You've seen the headlines. Silver squeeze collapses. Panic selling ends the rally. They're pointing to that violent drop from $84 down to $71.40 in late December as proof that the institutions won, that this whole thing was just another retail fever dream that got crushed under the boot of the big banks. But here's what they're not telling you. The screen is lying to you. While the paper price sits quietly around $72, looking tame and under control, the internal mechanics of the global silver market are absolutely coming apart at the seams. This is not a normal price correction where weak hands get shaken out and everything goes back to business as usual. What we're seeing is the physical inventory, the actual metal, disappearing from the system entirely. I've been analyzing commodities markets for 12 years, and I started this channel specifically because I was tired of waiting half a day for mainstream outlets to report what I was watching happen in real time on my feeds. I'm not a YouTuber. I'm a trader and a physical stacker who happens to use this AI avatar because it is the fastest way to get time-sensitive information out to people who actually need it. There's too much garbage content flooding YouTube right now. AI-generated nonsense with fake news designed to pump whatever narrative is trending. I wanted to cut through that and give fellow stackers and retail investors the actual data. So here's what's happening behind the curtain that you won't see on CNBC tonight. The banks are not just defending their short positions. They're desperately scrambling to borrow metal that simply doesn't exist anymore. And that, right there, is where the phantom event begins. Let me lay out my thesis for you clearly. Behind that rigid price ceiling at $74.53, what I call the people's wall, the physical silver market has reached a genuine breaking point. The metrics that matter, the ones that institutional traders actually watch, like lease rates and swap spreads, are screaming that the system has officially run out of lendable metal. We're not talking about a temporary squeeze. We're talking about a structural shortage. What we're witnessing right now is a historic divorce. There's the paper price. That's what you see on your phone, what flashes across the ticker, what the media reports. Then there's the physical reality, what it actually costs to get your hands on a bar of silver right now, today, in the real world. These two numbers are supposed to stay close together. They're not close together anymore. In this video, I'm going to pull back the curtain on something called the lease rate mechanism. It's the market's ultimate alarm bell, and right now it's ringing louder than I've seen in years. I'm going to walk you through the math on the negative swap spreads, show you exactly why buyers in the East are paying a 12% premium to strip every available ounce out of Western vaults, and I'll share my personal battle plan for the 74.53 level. This isn't just about making a trade. This is about understanding that we're watching a pricing system reach the end of its functional life. When the physical and paper markets split this far apart, something has to give. And historically, it's not the physical market that bends. So stop what you're doing and look at this with me. I was pulling up the data a few hours ago, early afternoon Eastern time, and here's what the markets were showing. Silver spot bid price, $72.82, quiet, controlled. Up a measly 0.24% on the day. Gold was sitting at $43.32, actually trading down about 1/3%, which creates this false narrative of weakness across the precious metals complex. Platinum was up almost 2% at $21.37, showing that industrial metals were actually pushing higher. On the surface, this looks like a market that's consolidating, catching its breath after that violent rejection at $84. The bears are out in force saying, see, the squeeze is over, the rally is dead. But that's the paper market talking. Let me show you what the physical market is saying. Before Christmas, the premium at the Shanghai Gold Exchange hit 12%. Think about what that means. In China, buyers weren't paying $72 for silver. They were effectively paying over $80 per ounce. 12% premium. That's not some minor inefficiency you can arbitrage away with a phone call and a wire transfer. That's a structural disconnect showing you where the real price discovery is happening. The paper price in New York is being actively suppressed by institutional sell walls. I can see them on the order books. But the physical metal? It's flowing east at a record pace. The inventory is being drained. Here's the question that should keep you up at night. If buyers in Shanghai are willing to pay 12% over spot, how long can the Western exchanges maintain this artificial ceiling before someone opens a vault and finds it empty? The answer is probably not very long. And that brings me to the mechanism I need you to understand. Now let's talk about silver lease rates. I'm going to slow down here because this concept is critical, and most people have never even heard of it. A lease rate is the interest rate that a bank or institution pays to borrow physical silver bars, not paper contracts, not futures, actual metal sitting in a vault. In a normal, healthy, well-functioning market, this rate should be close to zero, maybe 0.5%. It's basically a storage fee and a small premium for the lender taking on counterparty risk. When lease rates start climbing, it means something fundamental has changed. It means that the people who own physical silver bars are not willing to lend them out anymore. Either they don't trust they'll get the bars back, or they believe the bars are worth more sitting in their vault than whatever interest rate is being offered. The lease rate is essentially the market's fever temperature for physical scarcity. And right now, that fever is running hot. Let me give you an analogy. Imagine you need to rent a car. Normally, it costs $50 a day at the rental place down the street. You show up one morning and they tell you it's now $500 a day. Your first thought isn't, wow, people suddenly love renting cars. Your first thought is, they don't have any cars left. The lot is empty. The few vehicles they have remaining carry what I call a scarcity tax. That's exactly what's happening in the silver lending market right now. The 1-month silver lease rate just hit 8.53%. The 100-day average is only 6.28%. This is a massive spike. This is the market screaming that there's a shortage of lendable bars. Now here's why this matters so much. Institutional short sellers, the big banks, the hedge funds running arbitrage strategies, they need to borrow silver to maintain their positions. If you're short silver, you've sold something you don't own, which means you need to borrow it from someone who does own it. That's how shorting works in the physical commodity space. If you can't borrow silver, or if it suddenly costs you 8.5% annually just to rent those bars, your entire trade becomes a ticking time bomb. You're paying through the nose every single day just to maintain a position that is already underwater if the price moves against you. The high lease rate is the market's way of saying, we're not lending anymore. The vaults are getting thin. But the lease rate is only half the story. The real kill shot is hiding in the swap market. Let me explain how swaps normally work, and then I'll show you why the current numbers are so alarming. In a typical silver swap, you're exchanging immediate physical delivery for future delivery. The price difference between now and later, the swap spread, is usually positive. You're paying for storage costs, insurance, maybe a little time value. It's a normal cost of carry relationship. But right now, something extraordinary is happening. The 1-year silver swap rate is trading at negative 7.9%. Let me say that again. Negative 7.9%. This is 4 full percentage points below the 100-day average. In plain English, what this means is that the market is paying you, literally paying you a massive premium to take physical metal today instead of waiting a year for it. Think about the psychology embedded in that number. It means traders and institutions are so desperate to get their hands on physical silver right now, immediately, that they're willing to pay a huge penalty versus waiting. The fear isn't that silver might go up. The fear is that if they wait, there won't be any silver available to buy at any price. So let's pause and take stock of where we are. The paper price is telling you everything is fine. 72.82, consolidating, maybe forming a base, maybe rolling over. The technicals are ambiguous, but the math, the actual mechanics of the physical market, is telling you a completely different story. Borrowing silver costs 8.53%. That's the highest we've seen in years. The swap market is inverted by negative 7.9%, meaning there's a panic bid for immediate delivery. And the East is paying a 12% premium to drain Western vaults. The paper price says calm. The physical market says crisis. One of these signals is lying. And I'll give you a hint. It's not the physical market. The conservative estimate is that physical demand is currently outstripping available lendable supply by a factor we haven't seen since the last major squeeze. The vaults that backstop the paper trading system are running thin, and when you can't borrow, you eventually have to buy. Now I know what the skeptics are saying. I can hear it already. So let's address the bear case head on, because I want you to understand both sides of this trade. The bears point to that violent rejection at $84 and say, that's your blow off top. The squeeze is over. Look at that long wick on the weekly chart. The retail buyers exhausted themselves. The smart money sold into the rally, and now we're heading back down to 60 or 50 or wherever silver belongs. It's a fair argument on the surface. That rejection at 84 was brutal. A lot of late-stage buyers got trapped up there and probably panic sold on the way down to 71.40. But here's what the bears are missing. High lease rates often precede a final flush. It's actually a well-documented pattern. The institutions will deliberately hammer the paper price down to trigger stop losses and force weak-handed retail holders to panic sell their physical metal. Then the banks swoop in and buy that physical metal at a discount to cover their own borrowing deficits. It's a shakeout play. And it works because most retail traders don't understand the difference between paper volatility and physical scarcity. The other myth I need to bust here is this idea that price discovery happens on the COMEX in New York. That used to be true. For decades, New York was the center of the silver universe. But with a 12% premium in Shanghai right now, price discovery has moved. The real market, the market where actual metal changes hands at volume, is in the East. New York has become a discount window. And discount windows only work as long as there's inventory behind them. Right now, that inventory is flowing out faster than it's coming in. The institutions are trying to shake you out before the next leg up, but they're running out of time. More importantly, they're running out of metal. So what happens next? Let me walk you through the likely scenarios based on what I've seen in previous squeezes. First, expect rule changes. When lease rates cross 10%, exchanges and clearinghouses start to panic. They'll hike margin requirements. They'll implement emergency position limits to stop retail traders from piling in. They'll do whatever they can to defend that 74.53 resistance level, because if that breaks, the momentum algorithms kick in and this thing could gap up violently. Second, expect a media blackout. You will not see silver lease rates hit 8.5% on the evening news. They'll talk about gold hitting a new all-time high at 43.32. They'll talk about crypto or AI stocks or whatever distraction is trending. But they won't talk about the physical silver shortage because acknowledging it would accelerate the very bank run they're trying to prevent. Here's what I'm personally watching on my dashboard. First, any whispers of force majeure at smaller refineries. When a refinery can't source enough raw material to fulfill contracts, they declare force majeure and suspend deliveries. That's a canary in the coal mine signal that the physical supply chain is breaking. Second, I'm watching the 74.53 level. That's the people's wall. That's where the institutional sell orders are stacked. If we get a daily close above that level with volume, it signals that the paper manipulation has failed. Third, I'm watching for the lease rate to cross 10%. If that happens, the borrowing market effectively breaks. At 10%, it becomes uneconomical to maintain short positions. You either have to buy to cover or you bleed out from interest costs. And here's the thing. When you can't borrow, you must buy. There's no other option. That's when the real squeeze begins. Let me be very clear about something before I share my personal plan. I am not a financial advisor. I'm not telling you what to do with your money. What I am about to share is simply how I'm navigating this specific setup as it stands right now, early January, based on the data I'm seeing. I'm watching the daily close like a hawk. Here are my personal triggers. Trigger A. If silver manages a daily close above 74.53, I'm looking to increase my exposure. To me, that would signal that the manipulated wall has crumbled and we're heading into true price discovery. I'd be looking at call options or adding to physical, depending on premiums. Trigger B. If silver drops back to test 71.40 support and the Shanghai premium stays above 10%, I'm personally adding to my physical stack. I'd view that as a gift from the paper markets, a chance to buy physical at an artificial discount while Eastern buyers are paying massive premiums. Trigger C. If the Shanghai premium drops below 2%, that tells me Eastern demand is cooling off. In that case, I'm sitting on my hands and doing nothing. The thesis breaks if the East stops buying. Trigger D. If lease rates hit 10%, I'm preparing for extreme volatility. At that point, we could see exchange glitches, trading halts, rule changes, anything. The system would be under maximum stress. That's my framework. It's conditional. It's based on real-time data, and it could change tomorrow if the data changes. Let me bring this all together. The paper price is a distraction. It's designed to look stable, controlled, maybe even boring. But the lease rates at 8.53% are the real signal. That's the market's alarm bell, and it's ringing loudly. The physical silver is moving east. Buyers in Shanghai are paying 12% premiums. That metal isn't coming back. The Western sell wall at 74.53 is the last line of defense for the institutions trying to maintain control of this market. We're in what I call a pressure cooker phase. The consolidation around $72 isn't weakness. It's not the market giving up. It's the spring being coiled. Pressure is building in the physical market while the paper price is being held down artificially. That's not sustainable. Something has to give. And here's the bottom line that everyone needs to understand. The institutions can manipulate the price. They have the capital, the algorithms, the order flow. They can pin it wherever they want on the screen, at least for a while. But they cannot manipulate inventory. They cannot print physical silver bars. They cannot create metal out of thin air. When the vaults are empty, the game is over. That's the bet I'm making. That's the thesis I'm positioned for. Not because I think I can outsmart Wall Street on a technical chart, but because I understand that physical scarcity eventually overrides paper manipulation every single time. Now, if you want to understand how we got to this $74 wall in the first place, you need to see what happened during that December dump from 84 down to 71. The blow-off top logic, the institutional defense strategy, the technical patterns, it all matters for context. I broke that down in the previous video, so check that out to see the full picture of how this pressure cooker got built. But for now, know this. We're in the quiet phase before something big. The data is clear, the math is clear. The only question is timing. And in my 12 years watching these markets, I've learned that when lease rates spike like this, when swaps invert like this, when Eastern premiums explode like this, the market is trying to tell you something. It's trying to tell you that the paper system is reaching its limit. And what comes after that limit is anyone's guess. But historically, it's been violent, it's been fast. And it's caught most people completely off guard. I don't want you to be caught off guard. That's why I'm here, putting this data in front of you while it's still actionable, not 12 hours later when it's already on the evening news. Stay sharp, watch those levels, and understand that we're not just trading a commodity here. We're watching a century-old pricing system potentially come apart in real time. That's the video. If this was helpful, you know what to do. And I'll see you in the next one when the data updates again.